All right. So this is the physician first time homebuyer class. This is my 2021 edition. Just because there have been some changes with COVID, with buying a home as a physician with some of the physician mortgage loan products that are available and that are out there. So we'll go ahead and get started. Quick intro, this is me and my family. So there's me, and then my husband is an anesthesiology resident right now. He's at the University of Utah. I've got 3 girls. As you can see, I kind of just pasted her in there, as you guys would imagine in residency and medical school. We don't have a lot of time to go out and take family pictures. So this is kind of our makeshift family photo. I've been doing real estate and mortgages for the last 10 years. And I've learned a lot personally through, being a realtor here in the state of Utah, and just by being a physician wife and trying to figure out what the best thing is for me when I was buying my own home. So I've learned a lot, and I want to share that with you. So I'm going to go ahead and get into the actual meat of the presentation. So when people are asking me about buying a home, the first thing that most people ask is, okay, well, I'm thinking about buying a home, or I'm in 4th year and I'm in my last year of medical school and I'm thinking about buying in residency. When do I need to start thinking about getting ready to buy a house? When should I start looking? This is just kind of a basic overview, just kind of the home buyer timeline of exactly what you should kind of expect along the process. So usually, if you're looking at buying a home, you want to start anywhere from 1 year to 6 months to a year out. And I'm going to go into each of these little timelines in more detail as we go along. But this is just kind of the general process overview of what you should expect when you're looking to buy a home. So within the first 6 months, you're going to want to prepare your credit and your down payment. And so with that, preparing your credit and your down payment, you're going to want to start saving up if you're going to put a down payment. That can take years, especially as residents and medical students and early attendings, as we're trying to balance living off of the wage that we're given, or no wage at all in medical school. And so, saving up for a down payment, for many of us, we don't really do that. A lot of us do the 0% down programs, and I'm going to talk a little bit more about that down in this area. But the best thing that you could do is start working on your credit and your down payment. And I'm going to talk about credit here in just a little bit. So 6 months to a year out, that's what you want to be doing. 3 to 6 months out, you want to start getting, usually about 3 months out, you want to start looking at getting pre-qualified with a bank or a mortgage lender and start shopping around and comparing those quotes to make sure that you're going to get the best deal that you can for buying a home. So that's what you'll want to start doing about 3 months before you start looking for a home. And then it's go time. When you are ready to start looking at homes, you start looking at them, you start submitting offers, you have your pre-qualification, so your offers will actually be considered. And then once you get under contract, it actually still takes about 30 to 45 days after you get the house, you get under contract, and then you have to get all your financing and your loan all done and a bunch of different other things within the real estate contract before you actually close on your home and get to move in. So that's just kind of a general process overview of what to look for when you're looking at buying a home. 1 second, I am going to stop my screen share just for a second to see. Okay. All right, let me get back to that. Okay. So I'm going to move on to the next slide, and then I will go ahead and ask if there's any questions after I explain this next part. So 6 months out, you want to be working on your credit mix and meaning. So what that is there are different types of credit, that different parts of your credit that build your credit or decrease your credit. You might have seen this graphic before. This is what your FICO, like when you hear like, oh, what's your FICO score? This is what your FICO score is made up of. And with the FICO score, the biggest thing that contributes to whether you're going to have a higher or a lower score is your payment history on your mortgage, or not your mortgage, on any of your debts. And so are you paying them on time? That's the biggest factor that determines kind of what your score is going to be. The next part is the amounts owed. How much do you owe and how much available credit is actually being used? I'm going to talk about on the next slide how we can actually get into the minds of the creditors and how they determine like what's good credit, what's not, and help you to know what you should probably be doing right now in regards to this, if we can, in regards to if you're trying to get your credit up. The next biggest thing is credit length. How long have you been using credit? So there's a lot of banks out there who, if it takes about 3 to 6 months to develop a credit history. And so if you want to get a physician loan, which I'm assuming most of you on here are going to want to go that route, you have to have a credit score or some kind of credit history. And so that's where, it's good to start looking at this as 6 months to a year out, because if you don't have any credit history and you really do want to buy a home, you want to use a physician loan, at least you got to have some credit. And so you want to start developing credit and credit length. The longer you have your credit, the higher your credit goes, as long as you're making your payments on time and you're not maxing out your credit. The other two types of credit mix and meaning are new credit. How much is new? So, and that's kind of like an average age of your accounts. So if you got an account a year ago and then you got an account, a month ago, your average credit or your new credit would be, your credit age would be 6 months. And the less new credit you have, and this is like new credit that you have actually gone out and you've got a credit card, or you got a credit card, or you went out and you got like a car, a loan on a car. Those are like new credit. Just like, getting credit pulled for like shopping around for a new car. That's not like new credit. That's just a credit pull. And a lot of people ask me when they're shopping for a mortgage, they're saying, hey, all these people are asking me to pull my credit. Is that going to really damage my credit score? And if you notice, credit pull isn't even on here. It's not even really, it does not super affect your credit at all, because everyone's really concerned about, oh, like, should I have my credit pulled? Because I don't want it to ding my credit a ton. Which is good. You want to be cognizant of who's pulling your credit and who has that information. But usually when you shop around for a mortgage, the first time you get your credit pulled, it might drop your score 5 to 10 points, but that's like after it's been pulled. So and once it's been pulled, they will hold that credit score. They get the 3 credit scores from the 3 bureaus, which is Equifax, Experian, and TransUnion, those 3 scores. And I'll show you that in the next slide. And they keep those scores, and those scores are valid for about 3 to 6 months. And usually within the next month, if your credit is pulled and the rest of this is good, it bumps right back up. So you don't want to give your information to everyone, but when it comes time to pull your credit, it's not going to take a 10% hit on your credit. So that's just one thing I like to point out, because it's a common question I get asked. Okay, next one is type of credit used. So they like to see a mix of credit, of different kinds of credit. So for example, student loan credit with our our student debt, that's one type of credit. Auto loan, that's a different kind of credit. Credit cards, having, it's called revolving credit, where it revolves and it goes up and down and has payments. It's kind of just like an open credit. Having different types of credit actually does show your responsibility to the credit bureaus. And what it does is it actually increases your score. So I always use this as an example. My husband and I needed a car for third year because he needed to commute to a hospital that was 15 minutes away for his rotations, and I wasn't going to drive him and pick him up every day. And so we needed a new car. We had the money to pay cash for it, but they were doing this like 6 months, zero financing, 0%, no payments. And we're like, might as well keep our money for 6 months before we just like buy this car. So we did that. And during those 6 months, I usually had been hovering about a 760 credit score for a long time. And the only type of credit I had was a credit card. I didn't have auto, I didn't have student loans, I didn't have anything on my credit. And then when I got that car loan for those 6 months, my credit actually jumped 40 points to 806, because that was the last thing that, like, I didn't have any mix. I just had a credit card. That was the last thing that kind of boosted my score, was like, okay, yeah, finally you got some different credit in there. Now, 6 months later, we paid the car off. We paid that auto loan off. And guess what? You would think that we were being financially responsible and that they would reward us for that. But actually what ended up happening is my credit score dropped back down to 760 because I no longer had that different mix of credit. And so it dropped back down. And so paying off credit cards, or like 100%, like paying off credit cards or closing accounts, isn't always necessarily the best thing to do to increase your credit. The best thing you can do to figure out, like, how can I increase my credit, or what kind of score do I need? Am I in the good range for what I need to buy a home? Is actually the best thing that you can do is talk to a mortgage loan officer, and they can actually do something called a what if simulator. They can put it, like, they pull your credit and they give you your scores, and they can actually go in and manipulate those numbers in your credit report and say, oh, well, what if they had this much of a balance on this account? Or what if this account was closed? And they can actually tell you exactly what will happen to your credit if they change a few things, and they say, oh, you need to get your credit up to a 700, pay this card down $50 and do this on this card or on this account, and then we can get your score up. So it's always good to start working with a mortgage loan officer, 3 to 6 months out, because they can help you increase your credit if needed. Okay, any questions before I go on to this slide? This just kind of goes into credit a little bit more about how it's a good rule of thumb just to know for your general life, even if you're not buying a home. But any questions on any of this so far?
No, not yet.
Okay, awesome. All right. So so with this, so some tips. You don't want to be using more than 30% of your credit at any given time, of your total credit. And once you get over 30%, instead of it positively impacting your score, it actually starts to negatively impact your score. So for example, say you have a credit card that has $1,000 credit limit on it. If you are able to keep your balance under $300 at any given time on that $1,000 card, then it's going to help your credit to increase versus decrease. Once you start, like, if you have like a $400 credit line or a $500 credit balance on that credit card, then at that point it starts to decrease your credit. So in regards to this, anytime I have, and this is what I do personally, but I have a Discover card, and anytime they offer me like a credit increase, I take it. Not because I'm going to go out and spend more money, but because it starts to increase this ratio. So say that $1,000 credit limit on that card, now was bumped up to $2,000. So now I could have, you know, now if I have $300 on that $2,000 card, I'm only at 15% ratio of what I could be using versus what's available versus 30, and that's gonna make it better. So even though I'm still spending the same amount of money, the fact that I could have, I have the potential to spend more, but I choose to spend less, that shows responsibility for creditors, and they like to see that. So 800 plus scores only are using about 7% of their credit at any given time. Like their revolving credit for like credit cards and things like that. So in the example that I told you, if you only had $1,000, if you only have like $1,000, then you would want to be only spending like $70 on that card to keep it at 7% if you want like 800 plus, right? But as long as you're under 30, it's going to have a positive impact on your score. Now, it doesn't mean that you can't like go over 30 or over 7. It just means that, you know, sometimes, you know, like what I've done to keep my score up is sometimes like if I had like $1,000 credit limit and I was going to spend $600, is like I could still spend that, but I would get on and I would pay it down to the, you know, before my payment was due, I'd pay it back down to the 30% as soon as I could. Just to, and you want to make sure, and I don't want you to confuse this as carrying a balance. This is meaning like you still pay off all the balance every single month. So if you spent $600, your statement says $600, you pay all of it. Like you don't want to be carrying a balance ever. You always want to pay the full amount of your credit, so it's not accruing interest at any given time. This is more about before you pay your bill that's due. If your credit is starting to get above this threshold of 30 or 7%, like what you're trying to get, then you want to make sure that you pay it down before then, so it doesn't start to get closer to that limit and make them a little nervous and therefore bring your credit down. The other thing with this is there's also the opposite. If you have credit cards and they all have a zero balance on them and you're not using them at all, that also will decrease your credit. So 800 plus credit scores are not the people who never use credit and their balance is always zero. It's the people who use credit and use it wisely and, you know, either have larger credit limits so they look like they're being responsible because they're not spending as much, or they're just trying to keep it hovering around that magic number of the 7% balance. So that's kind of some tips just about your credit. One thing that you can kind of start working on. But if you really need help with your credit, usually, and I'm going to point this out in one of the next slides, usually you need to have, for a physician loan, 700 credit score to qualify. So if you don't have a 700 credit score above, then for like a physician mortgage, then it would be good to get working with a loan officer a year to 6 months in advance so they can help you to try to figure out what can we do to increase your credit. I had a client who started a 580 credit score, and they worked with a loan officer and a credit repair company in tandem to get them to be able to qualify, and they were at they got above 700 in a year. So it's totally possible if you need to do that. Non-physician mortgages, you usually can go down to as low as 620. So if for whatever reason your credit isn't great and it's in the lower 600s, it doesn't mean you can't buy a house. It just means you probably won't qualify for a physician loan. And then the loans that qualify to the general public are going to be more of what you're looking for. So here's the next thing in regards to credit scores. So I told you that there's those 3 scores from the 3 bureaus that are pulled when they're trying to figure out what your qualification credit score is for a mortgage. So the way they do it is if there's one person on the loan, say it's your spouse's or your partner, say that there's just one person on the loan. They're going to pull all three of your scores from the credit bureaus, and they're going to not use the bottom one. They're not going to use the top one, but they're going to use the middle one for your qualification for like, what's your credit and how does that fit into the mortgage? Now, if you have, if you're going to be on the mortgage loan for whatever reason, if you have an income, or if you're the one who's going to be making money, like if you're in medical school and your husband's not making anything, or your partner, then what you would do is, if both of you want to be on the loan, then what would happen is, say your credit's a whole lot better than this person's. Say yours is 800, 802, 804. Unfortunately, even if you have fantastic credit, if there's someone else on the loan with you that doesn't have as good of credit, they're going to take the lower of the middle two credit scores. So if it was just you on the loan, then you would get an 802 as your qualifying credit score, which means that your rates and your closing costs are going to be a lot less. Now, if you have to use this score, the lower of the middle scores, even though yours are good, you're not going to get rewarded for it. They're going to qualify them based off of that. So that's kind of how the mortgage loan part works. All right, so now we're going to move into, you've been working on your credit, you've been working on saving up for a down payment, if you are going to put a down payment down. And we're about 3 months out from looking at, starting to look at homes. So this is where we start the actual loan pre-qualification process and the home search. All right, so I like to bring this up just because a lot of people don't know what this means, and they get kind of confused with the terminology when people are talking to them about home stuff. When you go to a bank or anywhere to get a loan, you're going to be working with a mortgage loan officer. There are two different types of lending institutions out there. There are brokers and there are banks. Brokers are independent contractors. They search the country far and wide for the best lender or the best, kind of secondary bank. And they act as a broker between you and those different companies. They usually have multiple different companies they can work with you for. So I compare it to they're like Expedia and Kayak and Priceline of mortgage loans. They go out to all these different banks and they figure out, okay, who's got the best deal for what this person is searching for? And then they give you those options. And usually they just present you with the best option. And they say, hey, I looked at all these different banks. This one looks like it's the best one for you. And those are what brokers do. They're not personally lending their own money. They're going out to a different bank or company that does mortgages, and they are shopping for you, essentially. Then there are banks. Those are the ones who are doing direct in-house financing. They're only going to give you the rate for their institution. So that's like Wells Fargo, Chase, Ally. Some of the more common physician loan banks that you're going to hear of is like Huntington Bank is a big one. You're going to hear about Key Bank is another big one in physician loans. There's Chemical Bank. There's most of the physician loan programs that I know of are banks. And the reason they have to be banks more so than brokers is because to get a physician loan, a true physician loan with all the benefits that come with getting the benefits from your degree, you don't have private mortgage insurance, your rates are lower, and you can do 0% down. There's a secondary market that buys long-term loans, like the government buys loans from all these different people. And they just get to collect the interest off of it. And they pay these people money to take it. That's called the secondary market. A loan will not sell in the secondary market unless it fits the guidelines of the government institutions that will buy them, which is Fannie Mae and Freddie Mac. So what that happens is, so most physician loans have to be from a bank because those things that I just told you, 0% down, no mortgage insurance, those kinds of things that really give us the benefit of being like getting these special loans. They have to lend their own money and keep it and collect the interest off of you over time. And they can't like sell it off to someone else later, which makes them usually we're working with banks. Not saying that there aren't some brokers out there that do physician loans, but most of the time it's banks because they're lending their own money. One thing I want to point out, I do get a lot of questions about, oh, well, what bank or like where should I shop around for like a physician loan too. I do have another, I have another class that I posted on YouTube already. It's my second class, how to shop for a physician mortgage. That one's already on YouTube, and I kind of break all of that down in that class. But usually like reputable sites like White Coat Investor, most of the ones on those websites, those banks are, or, you know, brokers are physician loans, and they do provide you some of the benefits. It's different for each state. And so I can't like generally tell you like, oh, go look at these places specifically, because some banks lend in some states and some don't. So White Coat Investor has a good place to start, but you want to be careful because those people do pay to advertise on his website. So it's not like they're necessarily the best deal for you just because they're on their website, but it's a great place to start when you're trying to shop for a physician loan in the market or in the state that you are in. Okay, so I'm going to give you the breakdown of what is the benefit of you using a physician loan versus just a standard, you know, go to my local bank and get a normal loan. What are the perks of using a physician loan and kind of what you can expect or what the qualifications are. So credit score requirements. The lowest I've ever seen is 680. With COVID, they bumped that back up to 700 again for most of the banks that I've seen and I've worked with. So most of the time you need to have at least a 700 maybe. And if you're doing 0% down, then they usually require like 720, but 700 to 720 is a good ballpark. Down payment minimums, 0%. We can do 0% as physicians, which, you know, coming out of residency when you're broke or coming out of medical school, it's amazing to be able to get 0% down, especially when mortgage interest rates right now are like sitting around the 3s. And if you have the federal student loans after the forbearance is over, most of us are in the 6s to the 8s if you have the federal ones and you haven't refinanced. And so when you can put your money towards those interest rates versus like, oh, I can put 5% into my you know, I can sink $20,000 into my, you know, 7% loan. That's, you know, $200,000-300,000, or I can put $20,000 into my mortgage that is only, you know, 3%. A lot of people are like, yeah, I would rather put that money towards my student loans. And so even if you had anything, right? A lot of people don't have anything at all coming out of residency and medical school. And so these down payment minimums are, is awesome. So 0%, you don't have to have any down payment to get into a home with most physician loan products. Now, if you do have money you want to put at your loan, your interest rate gets better in increments. So at 5%, 10%, 20% down, your rate will get better. So say at a 0% down, you were going to get a 3.25% rate. Usually at a 5%, you're going to at least get like a 3.125 or maybe even a 3%, and so on and so forth. Rates will get better as you put more down, because you're less risky. Student loans. So our student loans, if we had to go by what the standard market does, like if you were to just show up at any Joe Blow bank downtown, most of them are going to require you to use 1% of your student loan balance as your monthly payment. So say that you have $300,000 student loans and you as a resident make $4,500 a month. If you're like on the good side of residency, they would be saying, okay, well, you can only qualify for like, you're making $4,500 a month and we're using 1% of your student loan balance, $3,000 a month of your student loans to try to qualify you. That leaves you $1,500 extra for everything else. There's no way. There's not a single medical student or resident just on a resident income who would be able to buy a home if they had to use this 1% of the loan balance. Now, most physician loan lenders out there will use your income-based repayment. If you're using the federal student loans, instead of using the 1% or the full balance, they'll use your income-based repayment, which for a lot of residents is, sub $200, maybe even $0, depending on your family size. And so that alone makes it so you can actually qualify for a loan. Whereas if it wasn't a physician loan and they couldn't use your income-based repayment and you had a large student loan balance, you just wouldn't be able to buy a home. So that's one of the perks of using a true physician loan lender. There are some lenders that are like physician loan lenders, but they have been requiring this 1% of the loan balance. I'm working on one right now with a client where we're trying to get a letter from the Fed loan saying that even though, they have this 1%, that their income-based repayment plan will be set for a year and this is what it will be, trying to see if they'll accept that. But for the most part, most banks don't, they just use your income-based repayment, or they don't factor in your student loans to your qualifying ratios at all. And I'm going to talk about qualifying ratios just very briefly in a future slide of kind of like what you need to have to qualify. This is the biggest thing. There's no mortgage insurance. This is huge. So private mortgage insurance, I'll just briefly explain what that is. Private mortgage insurance is essentially, if you're putting anything less than 20% down on a home, you're a lot more risky to a lender, because if the house loses value and you have to foreclose on it, they had to put up more collateral up front, so there's a higher likelihood that if something bad happens, they're going to lose money. And so usually if you're putting less than 20% down, you're seen as more of a risky borrower. And so you have to pay something called a monthly mortgage insurance. That is usually, depending on the home size, it's anywhere from, $20 to all the way upwards to $300, depending on the size of the home. And so, no mortgage insurance, even if you're putting less than 20% down. So that's like, a couple $100s a month you save by not having to pay that, even if you're putting less than 20% down. Traditionally, with mortgage insurance, if you did have less than 20% down, as soon as you can show the lender that you have that you've put in 20%, like either through your mortgage payments or if the home appreciates, and now you have 20% equity in the home, they will drop the mortgage insurance off. And so usually if you just make your normal mortgage payments, it takes about 7 to 8 years for that to drop off. But the fact that we as physicians don't have any mortgage insurance at all, it's a huge win. And it's not even wrapped into the rate. I go into that a little bit more in my Homebuyer 102 class. So a lot of banks out there will advertise, well, we don't have mortgage insurance. But honestly, what they really do is, if you were to compare it to an actual physician loan that truly doesn't have mortgage insurance, if everything else was the same, they would say, okay, well, we're not going to charge you monthly mortgage insurance, but what we are going to do is we're going to increase our rate. So, you know, a physician loan that was a 3% rate that had truly no mortgage insurance would just be 3%. Whereas maybe a competing bank who said, oh, we don't have mortgage insurance, but their rate might be like 3.25 or 3.5%, to make up for the fact. So it can get wrapped into the rate. So true physician loans don't have any PMI at all. They're not even wrapped into the rate at all. And so the other thing is they allow higher loan limits. So with a standard mortgage, what happens is actually with the higher loan limits is you can they're usually set by the government and the counties saying, okay, usually you can't lend more than this amount to this person, and they're a lot lower. So the loan limits are actually like $1 million. You know, you can go up to, it's usually 750,000 to 1 million for 0 to 5% down. For most 0% down programs, it's 750,000. Now you might be thinking, holy cow, like that's a big house, you know, especially if you're like looking in the Midwest. But if you're looking on East Coast right now, a lot of the different, if you're looking like on the East Coast, a lot of the different, different homes in those areas, like 750,000 is actually like a pretty like moderate home. Like it's not anything big or special. So that's kind of nice because like otherwise, like in my state, you could only do $500,000 loan amount. Like they're not going to let you go more. They won't let you go more. So that's kind of like a nice perk that you could get a larger loan. These are just kind of the breakdowns. So if you're like an attending and you're looking at getting maybe a little bit bigger home, then they'll allow you to do these, you know, larger loans, but you just have to have a little bit more down. Jumbo loan is where, you know, in the standard market, they would give you a loan for the 500,000. But then they would also give you a loan for a bigger one, but then it becomes a jumbo loan and the interest rates are a lot higher. The costs are a lot higher. And so this is one of the perks of a physician loan is we don't get into doing jumbo loans because they do allow higher loan limits. For half of the United States, going up to 750,000 isn't going to be an issue, period. But it's just something that's another perk of using a physician loan. Okay, so to continue with some of these physician professional loan facts, all of them that I know of are conventional loans, which means that conventional loans are the loan types that it's the best kind of loan you can get. There are different types of conventional loans that you can get out there. You can get a fixed rate mortgage or an adjustable rate mortgages. Adjustable rate mortgages used to scare me when I first started. I was like, ooh, why would you ever want like an adjustable rate mortgage? But a fixed rate essentially means that it's a fixed period of time, your payment never changes, your interest rate never changes, and it's just steady for whatever loan term you choose, which most people choose 30 years. An adjustable rate mortgage, you can choose a 5, 7, or 10-year term. And what happens is your rate is the same for whatever the term you choose. So if you did a 10-year adjustable rate mortgage or ARM, if you did a 10-year ARM, usually what happens is you get a quite a bit lower rate for those 10 years. And that's kind of appealing to a lot of medical students and residents or even early attendings because you're thinking about your monthly income a little bit more and your month-to-month income's a little bit more tight. And so doing an adjustable rate mortgage during like the medical school or residency years seems to be a common thing that a lot of people do. A lot of people will choose the 7 or 10 year rate because most residencies aren't more than 4 to 5 years unless you're doing like surgery and then fellowships and all of that. And so most people are like, okay, well, if I'm in residency, I'm going to be here for 5 years. I can get a 7-year adjustable rate mortgage take advantage of the lower rate. And I'm saying like, usually it's like a 0.5% difference. So, if you were to do like a fixed rate mortgage, and you'd have a fixed rate of like 3.5% for 30 years, if you did an adjustable rate, say like a 7-year, then your interest rate might be as low as like 3%, just for those 7 years. Then what happens is after the fixed year period term ends, a lot of people just either sell their house because they're moving and they're moving somewhere else for residency, they're done with residency and they're moving out of state, or they're like, hey, we got an attending job, we're staying in the same area, but we want to upgrade our house. So they sell their house anyway before that fixed period ends. Or if you happen to stay in that house and the fixed period is about to end, you can always refinance. You can refinance out of the fixed rate, or out of the adjustable rate, if you're scared that the rate will jump too high. And they actually have caps. They have it's called index and margin. They have caps on how much your rate could increase from year to year. So it's not like you could start at a 3%, during this time and then jump all the way to like a 5%. They won't allow that to happen. It would, if you did get into the adjustable rate period. But I personally don't know of anyone who has ended up doing an adjustable rate physician mortgage who has stayed in that same adjustable rate mortgage, after the fixed year period has ended. This is actually this is something that has been great for a lot of residents because it can save a couple $100s a month on your payment by having the lower rate during that fixed period. So that's actually something that if a mortgage loan officer brings that up, don't just automatically cut it off, like really consider it and talk to them about the pros and cons, because that has been a really great option for a lot of residents that I have helped buy homes. Okay. Reserves. Sometimes some banks require that you have some reserves sitting in your bank account for the amount of your future mortgage payment. Usually if you have more down, they don't require like anything. But if you're doing 0% down, say you're doing 0% down and you're a newly matched resident and it's March and your job doesn't start until July, is not when your first paycheck comes in, and your mortgage payment starts, say in May. And so you have May and June and July. They might say, hey, well, we need to see like that you have, 6 months of buffer in your account to make these mortgage payments, 3 months and a little bit of a buffer to make sure that you're going to be okay. And so depending on the bank, you might need to have a little bit of extra cash sitting in your bank account to qualify. But some banks don't require any reserves at all. But that's just something to keep in mind as you're, even if you're not trying to save up, if you're planning on doing 0% down for your down payment, you still might need to have some money sitting in your account for reserves. Okay, the next thing, work history and contract requirements. So if you are a W-2 or 1099 and you're a salaried employee, you can buy a house 90 days, so 3 months before the start date of your contract, as long as there's like a guarantee, like, saying, hey, your W-2, you're going to make this amount, or your 1099 and you're going to make this amount. Most residencies are W-2 and they give you a salary. And so match days in March. Most places start in July. So March, so you say March 15th, you got April 15th, May 15th, June 15th, July 15th. That's 4 months. So if you can close on a home, you can close on a home 90 days before your start date. And usually, once you've got under contract on a home, if we go back to my timeline that was on, the second or third slide, it takes about 30 to 45 days anyway, after you've offered on a home and got under contract to actually close on the home. So, if it's 120 days from the date of match day to to when your first start date is, then you literally can still put an offer on a home the day that you match, usually. Like, depending on, I mean, you want to get pre-qualified and double check and make sure that your lender says that that is okay. But generally speaking, you can do that. You know, the last few years, I have gotten people under contract, new residents relocating here. I've got them under contract the day after match day. They like they like sent me a house on Zillow and they said, we want to buy this house, and we put an offer in on it. They got it and we're under contract, and then they close on it. But they just had to make sure, like, they had to have enough reserves to make it until when their first paycheck started for residency. Same thing for if you're an attending. Usually you can buy a home, you know, 3 months, 90 days. So I usually say 4 months is a good number to keep in your head of like, what's the soonest that you could put an offer in on a home. It's usually 4 months, because you usually have a 30-day buffer for actually doing the contract before you close, and then the 90 days before your start date. Good to double check with whatever lender you're working with to make sure that is generally true with who you are personally working with. But generally, that's how it works, which is kind of awesome that you can get into a home, move in, get settled before you have to start working. If you are self-employed, so if you're starting your own business, or if you're LLC or sole proprietorship, you usually need at least 1 year history of filed tax returns to use for your qualifying income. So that's a little bit of a bummer. So if you start your own business, you usually can't like buy a house right off the bat. And it's similar if you start, like if you're part of a partnership or a corporation, like a C Corp or an S Corp, that just shares in the company's profits. Most of the time they need 2 years of business tax returns to qualify. So you have to like live and rent somewhere for 2 years. So it's good to know these things, because when you're looking as an attending and trying to decide, oh, you know, what's the benefits and pros and cons of one job versus the other, one job you might be able to move into a house immediately, depending on how it's structured in their contract. Another job, you might have to wait 2 years and rent before you can even qualify. Now, there are exceptions to these. They're like here in Utah, there's a local corporation that hires, you know, anesthesiologists, and they are all part of a partnership, and they don't have any guaranteed base. And so usually they would have to wait for 2 years to be able to get a loan from anyone. But this is where, if you are willing to search local banks and ask around, you might be able to find a niche product. It's called a portfolio loan, where the bank will essentially say, okay, you're an individual person. We're not going to offer this loan to everyone, but, you know, we sat down, we've talked to you, we've looked at a loan application, we've looked at, you know, what you could offer us by using us as your bank, maybe, you know, using us as your banking institution. And if you're willing to use us as your banking institution, we might be willing to pull a couple strings for you and get you a mortgage that we're willing to give to you personally from our own bank money, because of how we feel about, you know, our relationship. And so I do have people, I actually closed one yesterday where they were part of a S Corp. They were a partnership. There was no guaranteed base salary, but the bank actually was the bank for the company. And so they saw the ins and outs and what was happening, and they knew from years of experience, okay, even though this person doesn't have, you know, a guaranteed base, and they're part of a corporation, and usually we need 2 years, because we are personally the ones who are sending out their paychecks every week, and we know kind of how much they make, they're willing to make that exception. So these are general rules, but there are exceptions, and if you look for them, you might be able to find them. But it's just good to know that and have that information going into signing contracts and looking at buying houses, because I think it does. Like, it does make a difference if you are going to look at two different job offers and you're like, okay, one, I can get a house now. The other one, I'm gonna have to wait 2 years. I do think that that has some weight in, making the decision on what kind of job you might want to accept. Any questions with any of this stuff so far?
I did have one back with talking about the FICO score.
Okay.
So technically, can you, I guess, check your credit, like say on Credit Karma up until, I guess, the 6-month period where you really need to check it with FICO, or would you recommend just checking it with FICO initially and then at 6 months check it again to see where it's at? Or
Yeah. So, like, for example, if you have Credit Karma is great to track your credit. And usually Credit Karma is, and I can't remember, it might have changed, but usually it's only kind of giving you your FICO, which is, kind of like it just picks one of the bureaus. And so it could be quite a bit off, like, because it might be picking your highest one, or it might be picking your lowest one. So I would say that you're totally fine to manage your credit because it gives you a good ballpark. You're totally good to manage your credit that way through Credit Karma, all the way up until it's time to like get pre-qualified, right? And then if you're 3 to 6 months out and then you go to a loan officer and they pull, it's called a hard credit pull. They will pull your credit. It will be a hard hit. And they will get the actual scores. And then at that point, if you are 3 months in advance and you're trying to get your score bumped up from like, a 690 to the 700, 3 months gives them plenty of time to help work with you through that before you start buying a house. So yeah, no, Credit Karma is a great, those kind of things. Like my Discover card gives me like a FICO scorecard every month with my statement, and it kind of tells me, oh, your credit's trending. That's a great way to just kind of keep your eye on it up until about 3 to 6 months before, definitely.
okay, cool. Thank you.
Awesome. Okay. So, all right. This is just kind of a breakdown of what's in a mortgage payment. You're going to hear this term a lot when you're, shopping for a mortgage or, talking about a home. So what is actually in your mortgage payment is it's your principal balance on your loan. It's the interest that you pay per month. It's your taxes and your home insurance. So for example, when we're paying our student loans, we're paying some principal and some interest as our payments for student loans. We have taxes and insurance as part of like the payment that you make to the bank or the lender. And the reason you have to pay your taxes and insurance, like it's not like your car insurance where you pay a 6-month premium. You actually have to pay it monthly to your mortgage servicer for the most part, unless you get a mortgage, like a escrow waiver, which usually physician loans don't do that. But you usually have to pay your property taxes and your homeowner's insurance to the lender as well. And the reason they require that is because your taxes and your homeowner's insurance are the two big ways that they could totally lose your home. Like they could lose the collateral and lose all of their money. If you were not paying your property taxes on a home and they found out at the end of the year, oh, you didn't pay your bill, then the government could actually come and seize your home, forcibly sell it, and they have the right to all the proceeds that they want/need. And then the lender would get whatever's left over. Lender doesn't want that. So they say, okay, we don't want that risk, so we're gonna make you pay your taxes to us. Same thing for your homeowner's insurance. They don't want you to be like, oh, oops, I forgot to pay my insurance and my house burned down. And now there's no collateral or no insurance to rebuild the property. So they're just out all their money. So that's the reason why you make your mortgage payment, not just your principal and interest like you would expect, but also your taxes and your home insurance. This is a good thing to have when you're starting to look for a house and you're starting to shop around and you're just trying to figure out, okay, I really like that house, but how much is that? What's the payment on it going to be? How much is it going to cost me? This is a great guesstimation formula that I give people to use when they're trying to be like, okay, what's my payment going to look like? So for every $10,000 of home value, you're going to have about $50 of monthly payment. So a $10,000 home, which they don't exist right now anywhere, you'd have a $50 a month mortgage payment. So if you tag a zero onto both of those, a $100,000 home, you're going to be looking about $500 a month of payment. So for every $100,000 of home value, you have $500 a monthly payment. So, here's kind of an example formula in action. So you have $220,000 home. You take 220,000, you divide it by 10,000, then you multiply it by 50, and that will give you a guesstimate of what your mortgage payment is going to look like. So if you are looking on Zillow, you find a house and you're like, man, I really like that house. That's a $500,000 house, but I have no idea what our mortgage payment is going to kind of look like. Then you just plug it in that formula and you're like, oh, that's going to be about $2,500. Are we comfortable with that? Can we do that? And then that makes it so you don't have to go to your loan officer every single time, anytime you're interested in any home, and say, could we afford that? And for physicians, it's actually usually a little bit less. It's probably closer to about 45. But for the sake of guesstimation, it's easier to do it that way. And it's always better to kind of overestimate than underestimate. Okay. So another thing that a lot of people, especially when buying a first time, like a home for the first time, kind of don't expect, or it's kind of something, it's a little bit of a blow, is that there are closing costs to obtaining a mortgage. And it's not like a car where it's like a $100 processing fee. It's actually thousands of dollars. So so you have your closing costs for the home. If you had a down payment, then you would need to have a down payment. But also there's the mortgage side of things where you have to pay to actually get the mortgage as well. And that's what your closing costs are. So these are the different loan closing costs. There's a loan origination fee. That's essentially paying your mortgage loan officer their commission for doing your loan and talking to the underwriter and managing everything. Then you have things like an underwriting fee. That's like the underwriter is the person at the bank who's actually going through your file and looking through your paperwork in detail and making sure everything looks good and asking questions if they need to. Processing is just kind of the paperwork fee. Then you have to record the home for it to legally be recognized by the US government as yours. It has to record at the county. Like it has to be, your deed on the home has to be recorded at the county. So there's fees to pay them to do that. You have to do an appraisal on a home, and that's required by the lender. So there's cost to that. You have to pay a title company to make sure that the home is free and clear of any liens, and that the person who's selling the home actually can sell you the home. It's assuring a clean title, kind of like a car. Then you have to pay for like your credit report fee. And then you have to set up an escrow account with the lender. That's essentially like the savings account for the principal and interest part that I was telling you about of your mortgage payment. Just in case that number goes up a little bit, they like to have a little bit of a buffer in an escrow account that they keep for you, just in case those numbers go up, like say your taxes went up or your home insurance went up. Instead of like coming to you around Christmas being like, okay, we need you to pay us $300 because you're short. They're like, okay, we don't like to do that. So they usually make you fund a little bit of an extra account at closing to make sure that they should never have to come to you and do that. And if you sell your home for whatever reason, then they refund that extra money back to you. They just kind of hold on to it for you. So there are closing costs to getting a mortgage. And these are usually, you know, in the thousands to tens of thousands, not like 20,000 unless you're buying like $1 million home. But, you know, they're in the thousands usually. But there's different ways that you can pay for the closing costs. You can have the bank help to pay for your closing costs. And usually the way they do that is they say, okay, well, we'll cover your closing costs, but we're going to give you a higher rate than what we said we would to help to cover our cost. You can ask the seller to pay in a real estate purchase contract. You can ask the seller to pay for some of your closing costs for your mortgage. Pretty much the consensus that I've gotten across the country from other realtors and people buying homes is that it's so competitive that sellers aren't doing that anywhere right now. Then number 3 is that you save up money on top of your down payment to pay for your closing costs. Or if you don't have a down payment, you just save up to pay for your closing costs, which is honestly like what most new residents and attendings do. They're just like, well, I can't do a down payment and pay for my closing costs, so I'll do 0% down. I'll use the money to help pay for my closing costs. Or they'll do a little bit of mix of both. Well, they might increase their rate a little bit to help the bank cover some of their closing costs, and they'll just pay you know, a smaller portion of the closing costs out of their bank account. This number is not a general number. It 100% depends on where you go to get your mortgage. It can be quite dramatically different. You know, I've had a client shop around at a couple of different mortgage companies before. This wasn't physician loan, just a normal client, where someone was literally charging him double the amount of closing costs for the same rate, same loan at a different company, just because, you know, they could. And if you don't shop around and compare quotes, you wouldn't know that you were getting absolutely, you know, just destroyed. I mean, it was like, you know, $5,000 in closing costs versus like 10,000. And that's why, like, I always recommend, even in physician loans, shop around to make sure that, you know, usually they're all pretty similar, to be quite honest. They're all pretty similar within the physician loan territory, but it's always good to shop around to kind of compare those so you can know for yourself, like, okay, these all look pretty similar, so they all must be pretty good, right? Rather than like, whoa, that person's really trying to take advantage of us here. Okay, so you've done the pre-qualification process. You've got a pre-qualification letter from your mortgage loan officer saying you can qualify for this price of home, and now it's time to start looking for houses. And so it's go time. So I shared this graphic just to let you know. I mean, I feel like we're all pretty intelligent people here. You know, and so a lot of people may or may not choose to use a real estate agent. But I want to bring up this statistic just to kind of give you some perspective as a buyer. 89% of sellers were assisted by a real estate agent, or they hired a seller agent, real estate agent on the selling side when selling their home in 2020. So me as a real estate agent, when I am representing the seller, I sign a contract with the seller to sell their home. And usually what I do is I say, okay, I'm going to sell your home, and I'm going to sell it for 6% commission of whatever the home sells for. If I find a buyer for you that doesn't have a realtor, or if I find, you know, someone who wants to represent themselves, I get to keep 6%. I get to keep the full 6%. But to make my life easier and to make selling your home go faster and smoother, I'm willing to split my commission as the seller side, and I'm willing to offer a 3% commission is usually pretty standard in the industry. And you can negotiate with an agent on the seller side. It doesn't have to be 6%. Commissions are completely negotiable. A lot of people don't know that, but you can negotiate with your agent on the seller side to sell the home. And so what that means is if someone comes with an agent, and I've agreed to split my commission and offer 3% to a buyer agent, That means that that person, I'll just split my commission. It just makes my job a little bit easier as a seller agent realtor. So what that means, because a lot of people have the misconception that they're like, oh, well, if I represent myself, I'm going to get a better deal. I'm going to get a better deal because I'm not using a realtor, because they don't have to pay the realtor fee. But traditionally, that's not true. All that means is that the seller agent gets to make double the commission. So usually what I compare it to is if you are going into court and you've been accused of a crime, and you've been accused of a crime, and you show up to court, and the judge essentially says, hey, look, we can pay for your representation. We'll give you, we'll pay for your representation. It's not free, but we'll pay for your representation for you to have your own separate lawyer to represent you. And it's not going to, the cost isn't going to come out of your pocket directly. The other people are going to, they're going to cover it for you. Or you can choose to not have a lawyer, go unrepresented, and that other lawyer is just going to keep all the money anyway. When you kind of put it in that perspective, you're like, oh, well, yeah, like if I'm looking at buying a house and like someone's going to essentially pay for my representation, then why not? Like, why not take advantage of that? Having my own separate person who has my best interests and needs in mind. Now, if you're able to find one of the 11% of people who are listing their homes in the United States without an agent, then yeah, you'll probably get a better deal on the home. Because they won't have an agent, you won't have an agent, and the commissions will probably just not be factored in at all. But 90% of the time, you will not, 89% of the time, you won't get a better deal by not using a realtor, because all that means is that the seller agent just made twice the commission and you just decided to be unrepresented. So I bring that up not because I'm trying to push you using an agent or not. It's just something to keep in mind, that like you won't necessarily get a better deal on a home by not using a realtor, unless you find one of those like 11% where it's completely real. It's a transaction that doesn't have any real estate agents involved. Okay, so this is kind of what the contract process looks like. So after you find a home, you get under contract, hopefully. Right now it's taking a couple of times and a little bit of tears to find a house. I'm sure you guys, no matter where you are in the United States, it's kind of a stressful time. But you find a home, you put an offer in, hopefully that offer gets accepted. Hopefully you're able to get an offer accepted on a home. Then usually the process goes like this. And this is usually within a 30 to 45 day process total after you get under contract. You will want to do a home inspection to make sure the house is safe and that there's no major things that would prevent you from wanting to buy the home. You'll have to pay for an appraisal that will be coordinated and ran through your bank. They'll find an appraiser and send them out for you. You just have to pay for it as part of your loan closing costs. Then you're working on securing all your loan financing. And so they're just asking you for a bunch of paperwork and documents, and you work on that. You get everything squared away, and then you close your home on the loan. And then you get to move in. After you move in, your first mortgage payment typically isn't due until 2 months later, because a mortgage is paid in arrears, meaning that you live in the house first, then you back pay for the time that you lived in it. Rent is different. You pay that up front, where you're like, okay, I'm going to move into this house. I prepay my rent. Then I live in the house. Mortgages are in arrears. So what that means is, say that you close on a home in the middle of March 15th. That usually means that you won't have to make a payment until you get to skip. So March 15th, you get to skip from April to May. And so then you usually don't have a payment until June. So, or March, April, May, you won't have a first payment till May. So you get to wait, you know, like a whole month and a half before you even make a payment, which is kind of nice because, like I said, most of the people, if you are, you know, a dentist, a doctor, a lawyer, and you're just coming out of school, most of us don't have very much to our names. So having your payment, you know, due like a month or two later after you start making a little bit of money is really, really helpful, to be able to know like, okay, that you get to take a little bit more time, to make that payment. This is just kind of a fun graphic. It's kind of nice. These are the 30-year average mortgage rates over the last, you know, 30 years. So we're here. It's an awesome time to buy a home, which is why it's also so competitive, is because rates are all the way in over, you know, they're in the threes and sometimes in the twos. You might get into the fours depending on what your credit is. But like if you look, you know, my parents bought their first home back in, you know, the 80s and the 90s, and their first home interest rate was like 15%. And so that's another reason why, you know, a lot of people ask, like, why are the housing prices just going so crazy right now? It's because they can, because people can qualify to buy more home because the rates are lower. And so it just fuels competition. And so when rates are higher, housing prices usually go down. When rates are lower, housing prices usually go up to kind of make up for that. But it's kind of nice. Generally speaking, right now, you're going to be looking in the 2s, 3s, and 4s for rates, which is pretty great. All right. I'm going to not do the 2 bonus slides on my How to Shop for a Mortgage class, just because I've already posted the whole class for that on YouTube, and you can go watch it anytime you want, and it's just a lot more detailed than this one. Are there any other questions that you have that I can answer while I'm on here?
I don't think so. This was all really helpful though. Thank you.
Awesome. And I do have a PDF. That kind of summarizes all of this if you want that. You can always like message me, just like if you are on Facebook or however you joined the class. If you want access to like that PDF that just kind of breaks this down and summarizes it, I can give you a copy of that as well.
Okay, that sounds good. I'll send you a message on Facebook.
Okay, awesome. All right. Okay, well, I think I'm going to stop this recording, and then I'll post it on YouTube for anyone else who wants to use it, and then we'll just go for there. So thanks for coming.
Thank you.
All right. Bye-bye.